Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us remotely, we have Russell Rhoads, who's the Head of Research and Consulting at EQDerivatives. We also have Tony Zhang, our Chief Strategist over OptionsPlay. We're going to take a look at trading options and what's been a volatile market. And Russell, we're going to kick this off with you. Can you comment on the recent index performance during the sell-off?
Yeah, it's really interesting. We're always being told that when we get a sell-off that, all ships go down together. But in the first quarter, admittedly, let's just stick with the three big indexes, the Nasdaq 100, the S&P 500, and the Russell 2000. There's a big performance divergence for the quarter. Nasdaq 100 was only down 10.5%. The S&P 500 was down 20%, and the Russell 2000 lost over 30%. The maximum low was much lower for the S&P 500, down about 30%, and the Russell 2000 down 40%, while the Nasdaq lost just a little bit less than 19 or a little bit less than 20% at the worst point during the quarter. But something else that I thought was kind of interesting is the low in the quarter came on 3 different days for each of the indexes. It's like each of them had their day where they were unloved, and it was in order, the Russell 2000 on the 18th, March 18th, needless to say, the Nasdaq 100 on March 20th, and the S&P 500 made its low on March 23rd. And they've all bounced very nicely off of their lows as well. The S&P is up about 15%, Russell 16%, and the Nasdaq's up around 12%, but it had gone down a lot less. So I don't think that puts any shade on the Nasdaq.
All right, and Tony, what are you seeing out there?
Yeah, so first of all, thank you so much for having me back on. I hope everyone's staying safe and healthy. But I wanted to take a look at the VIX to help many retail investors understand kind of where the markets are heading, because that's really the biggest question that we are getting right now. And, we always look at the VIX and we know that as a fear index. And I'm really glad to have Russell here with us. He's the absolute authority here on volatility in the VIX. But when we look at retail investors, we usually tell them to look at the VIX term structure, meaning we look at the relationship between the 1-month VIX, which is the VIX index that most people follow, in relation to the 3-month VIX, which is the same VIX calculated on 3-month options. And when the 3-month VIX is lower than the 1-month VIX and the ratio of those two indicators are below 1, we use this as a risk-off indicator. And if we look at the chart here, that actually triggered on February 21st, which is just 2 days from the peak on February 19th, which is pretty incredible. And at the bottom, it was just poked just above 1, meaning the ratio got back above 1, but it's pulled back well below 1 again. So we're still in this risk-off environment right now. So we don't think for retail investors, it's necessarily the best time to go long the markets just yet.
All right, Russell, I'm going to swing it back to you. And you noticed an interesting hedge that an investor put on during the sell-off. Can you walk us through this and any comments you have?
All right. Well, they actually were, they timed this thing perfectly. The strikes are almost. I mean, it's if somebody could, hang their hat on totally threading the needle on almost a perfect trade, this would be it. And back at the beginning of March, with the Nasdaq 100 around 88.77, somebody bought 4,000 of the 8,300 puts, the standard April 8,300 puts that expire in a couple of weeks, and they paid $315.10 for that. Those are very expensive options. But they also sold 4,000 of the April 75 puts, or 7,500 puts. Got to add a couple of zeros there. The net cost of this trade was $192.50 a spread times 4,000 times. And as I mentioned, the NDX was up at 88.77 at the time. We all know what happened throughout the course of March. And the NDX has spent more time under 7,500 than above 7,500. It's hovering right around there today. But that's down 18.4% from where the Nasdaq was when they put the trade on, and they're looking at a really nice return if we have the Nasdaq 100 close under 7,500 2 weeks from Friday. Actually, they're AM settled. I got to correct that for sure. If the Nasdaq standard April settlement comes in below 7,500, they've got a max gain of 607.50. And their break even was down 8.7% when they put it on. but we got down there very, very quickly. So not only was their timing very good, because believe it or not, on March 2nd, a month ago today, the Nasdaq was up on the year. It was up 1.6% for 2020 when they put this trade on. And right now, again, with the index hovering right around that short strike price, this is as close to a perfect trade as you can get.
Yeah, Tony, talk about a hedge really playing off.
Yeah, absolutely. What I find absolutely incredible about this trade is that last week, this trader would have had roughly almost $300 million in unrealized gains and left it there, even though on Tuesday or just earlier this week, he would have seen most of those gains evaporate. But holding on to those, he clearly had a lot of conviction that this market was continuing to move lower. And I think that speaks to, the views that many institutional investors that are putting on this type of hedge may have in this particular market.
All right, Tony, stay with me here. How are you seeing retail investors trade this market using options? And what strategy should investors look to in these volatile times?
So I want to point investors to understand a little bit more about VIX and volatility, because a lot of retail investors follow VIX, which is a very important indicator to look at, and also other generalized volatility indicators such as implied volatility percentile or rank. But sometimes those indicators may overgeneralize volatility. So I want to make sure it's important that investors understand the benefits of implied volatility percentile and rank, but also understand what type of indicators that they can use, and understand that they're not necessarily telling you the full story. An example of this is really when a lot of investors have been taught that when implied volatility is high, you want to sell credit spreads, and when implied volatility is low, you want to buy debit spreads. So what we have here is a chart of the skew. Instead of just looking at a generalized volatility, looking at how the calls and puts are trading both in the money, out of the money, and at the money. So when we look at the two popular option strategies, credit spreads and debit spreads, both of them require either buying or selling at the money options. So when volatility is elevated, those at the monies will be obviously trading at a much higher implied volatility. But we all know that when we're buying or selling, we want to buy low, sell high. So when we look at the skews, and this is an example of Microsoft call put skew from yesterday, as you see, the skew is not normal. The skew is actually skewing where on the call side, the in the monies are trading at a higher implied vol, and on the put side, the out of monies are trading at a higher vol. So what this actually means is that it's not always best to just simply sell credit spreads when vol is high or buy debit spreads when it's low, because in this particular instance, if you're trading a put credit spread, you actually negate a lot of the benefits of high volatility, because you're actually buying an out of the money put that's even at a higher volatility. So you really negate some of those benefits, and vice versa when you're buying a debit spread. In this particular case, if you're trying to buy a call debit spread, you're buying an in the money and at the money call, and then you're buying a out of the money option, or you're selling that out of the money option that has really low implied volatility, and you're also negating some of the benefits. So really be careful when you're looking at volatility, because you do need to do a deeper dive beyond just the generalized volatility indicators into skew, which sometimes give you a far better visibility into which strategy is best suited for your outlook.
All right, and Russell, you always have interesting observations as to how the volatility index reacted to the sell-off and subsequent bounce. Tell us about that.
Well, the volatility index, it ran up very, very quickly, as we would normally expect it to do, especially with the incredible amount of uncertainty that I think goes beyond the type of uncertainty that we dealt with in 2008. I mean, we've got business uncertainty, but a lot of other geopolitical uncertainty associated with the situation that we find ourselves in right now. Kind of piggybacking on what Tony was talking about with that out of the money put implied volatility being so high, for longer term investors, kind of mirroring what Warren Buffett likes to do, where he's got stocks that he likes for the long term, and maybe they're on sale right now. Taking a look at, selling some out of the money puts with the intent of maybe taking delivery of the stock. I know that's not appropriate for a lot of retail level investors, but we've actually seen where people will be buying put options that are maybe 20 or 30% out of the money on individual stocks, and pairing that with a short selling a put option where they think they might get put the stock. So they put on a very wide put spread that makes them follow the rules as far as not having naked puts out there, but also maybe using it as an entry point for something that they plan on holding long past the pandemic that we're dealing with right now.
All right, Tony, I want to talk about position management. I'm sure you're receiving a lot of questions from investors with positions that are in the red. How can some of those positions be repaired or salvaged using options?
Yeah, so to answer that question, obviously depends on your specific position and what your outlooks are. So I'll try to cover some of the major scenarios that many investors are currently finding themselves in. So first, we'll start off with just your typical equity investment. Many investors bought the dip as things were falling, or perhaps were invested in stocks before the sell-off. So as far as what should you do with your equity investments and with respect to options, it really depends on what your outlook for stocks are going forward. Now, if you have more of a bullish outlook and you think markets are going to recover fairly quickly, an interesting option strategy, it is a little complex, but it can be done, which is selling ratio call spreads that can improve your break even on a stock position and get yourself back to break even a little quicker. There are a lot of limitations to this strategy, so I encourage for anyone who's first time selling a call ratio spread to learn a little bit more before they venture into that type of strategy. If you have more of a neutral outlook, there's a pretty simple strategy of selling covered calls, because especially when implied volatilities right now are so high, you can generate quite a bit of yield, more than double what we typically see in terms of yield from selling cover calls. A very popular strategy as markets kind of trade sideways to provide a little bit of income on your positions, especially when companies are slashing dividends. So if you're continuing to believe that markets will continue moving lower, looking at buying put options on the stocks that you own, or a broad-based index like NDX or NQX for smaller portfolios, and even potentially buying some calls on VIX, and perhaps Russell can comment on that type of strategy. And for option strategies, if you bought some calls as things started to fall, or regardless of what type of option strategy you have, generally speaking, first of all, if you have an option strategy that you've lost more than 50% of the premium that you've paid for, whether it's a call or put, generally speaking, it's a good time to cut your losses and move on to the next one. But if you have some trades that you want to hold on to, it really depends on whether you're approaching expiration or not. If you're close to expiration, you might want to roll those strategies to a later month as you expect the stock to continue moving in the direction that you're looking for. But if you still have plenty of time left to expiration, you might want to hold on to those strategies a little as markets stabilize and calm down a little and volatility comes down. You might want to wait to roll those positions as they get closer to expiration.
Yeah, Tony, I appreciate you bringing up the NQX options. It's been a really good product for the advisors. Russell, any thoughts on using VIX options?
Sure. Using VIX options, as Tony mentioned in passing, the VIX call options, if you think we've got a second leg down coming with this thing, which would result in pushing VIX higher, having the VIX futures in backwardation, where they have been for over a month now, actually gives you an opportunity to maybe buy call options that will give you a little bit more bang for your buck if we get another spike in VIX and you have the futures play a little bit of catch up with the VIX. VIX started running up to 30, 40, and the front month future was at a good 10, 12 point discount. If you thought about buying calls then, you'd have done just as well as that NDX trade that we talked about a few minutes ago. I did want to point one other thing out that kind of goes along with what Tony was talking about with respect to different index options and maybe trying to get some things back. Keep in mind that the implied volatility of these things typically varies. Usually the Russell 2000 options have a higher implied volatility than NDX options and S&P 500 options in that order. And it's shown up historically with the long-term averages. However, when we get these volatility events, they all seem to run up together. And one day you might be better off taking a look at NDX options. Another day you might be better off looking at RUT options based on your outlook, because they seem to be reacting a little bit differently to those divergences in performance as well. And in fact, the only options that got more expensive than 2008 during our most recent event were S&P 500 options. Of the three big volatility indexes, VIX is the only one that made a new all-time high during all of this. Both RBX and Nasdaq volatility fell a little bit short.
And Russell, what are your thoughts upcoming earnings season? Some more volatility to throw into the market.
You know, my initial thought with respect to earnings season was going to be that I doubt anybody cares. But one of the great things about the NDX is there are a handful of very well-known stocks and very solid companies, which I think contributed to the outperformance of the NDX so far this year, that all report in the same time frame toward the end of April. In fact, about, I don't know, 35–40% of the weighting the NDX reports in the just before the last weekly expiration in April. And what I did was I looked, which is April 24th, and all of those companies, you can already see a little bit of elevated implied volatility in the options that expire right after earnings. You know, I'm talking about companies like Apple, Amazon, Facebook, Google, Intel, and Netflix. But you can also see the bump in the NDX options, which shows up every quarter. So even though we're in very unusual times, it looks like people are going to be paying attention to earnings season, and people are using options around earnings season already.
All right, and Tony, final thoughts.
Yeah, so my initial thoughts were exactly like Russell. I didn't think that earnings season was going to be that important, given there simply, there's no history to look at. I think we're all kind of in the dark as far as earnings season. But if I think back as far as, the questions that we're trying to answer right now, which predominantly is where are we headed? How long is this going to last? If you look at the companies, they were actually the ones to react first to the coronavirus. They were first to tell employees to stay at home and work from home. It wasn't the government that did that. So, and if we try to look at economic data, that data is going to lag by weeks or months before we truly get a sense for where this is going to go. So I am actually really looking forward to earnings season to look at the guidance that these companies are going to provide, because I think that's going to give us more of a quantifiable view into what is the impact and how long this is going to last. So I'm really looking forward to earnings season. Like Russell said, the end of April is packed with a bunch of names that I'm really looking forward to. So, I'm following this fairly closely.
Yeah, those are excellent points. Thank you both for joining us. Can't wait to have you back in studio at Market Site with me.
Yeah, I cannot wait to visit.
All right.
Cannot
Thank
wait
you
to get out of my house. Thank you so much.
Same here. All right, guys. Thank you so much. And thank you for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.